Okay, IAS 16, property, plant, and equipment. Obviously, a pretty important account when we talk about PP&E. For a lot of companies, the PP&E account and the various assets they have in that account will make up a majority of their balance sheet. Also, let's keep in mind that capital assets play a big role also when it comes to tax. If you dispose, when you come to disposals and the capital gains or losses that can arise from those dispositions. So obviously a very important account, and it can get complicated in a hurry. There's a lot of details that can go into that account, but to me, what it comes down to is just establishing a strong foundation with PP&E and IAS 16. And to me, that strong foundation, with a lot of topics in financial reporting, is composed of 5 elements. The first one is definition. Second one is recognition. Third one, it's initial measurement. Fourth, subsequent measurement. And then lastly is the recognition. So if you can get a strong foundation with those 5 points, if you can know those 5 points at the tip of your fingers, then you know you're in a great position to be successful with those complicated problems going into the CFE and in the workplace as well. Number one, definition. So to me, there's really 2 bullet points you need to know when it comes to definition, and the first part is you got to know that the PP&E asset is helpful to use in the production of supply of goods or services. And that element of the definition separates a PP&E asset from an asset held for sale. So right there, that's the first point. Second point is PP&E assets are expected to be used during more than one period. And that part of the definition separates those assets from office supplies or inventory. So again, there it's fairly simple in the sense that you got a definition that's composed of 2 bullet points: help in the production of supplies and expected to be used for more than one period. So if you know that, then right there, when you run into an asset, you know that you can easily detect if it's a PP&E asset or not. Point number 2 is recognition. Okay. And when do you recognize a PP&E asset? You do so when it's probable that the future economic benefits associated with the item will flow to the entity. So when is it probable that the entity is going to be able to generate money with the asset? And then second is when the cost can be measured reliably. So again, there's 2 bullet points that if you know the tip of your fingers, then you know when to recognize an asset, and you know when to put it on the balance sheet. The third point is initial measurement. And again, there, I mean, a lot of questions, a lot of real life situations can get pretty complicated. But to me, again, there, if you're able to know the tip of your fingers, 3 bullet points for the amount of the initial measurement, then a lot of the stuff around that you're able to maneuver fairly well once you know those 3 points and you have a strong foundations around those 3 points. So initial measurement, the cost includes purchase price. So that's pretty obvious. But in the purchase price, to me, I come up with a fairly simple equation. Purchase price equals obviously the amount on the invoice plus import duties, less trade discounts, less non-refundable taxes. Then you got any costs that are directly attributable. So comes to situations like site preparation, delivery cost, installations cost, borrowing costs. So those are the costs that you can directly attribute to bringing the asset to your facility and getting ready to go. And lastly is if there's any estimate for the cost of dismantling or decommissioning, very current in mining and oil and gas. So that's at the 3rd bullet point there. So 3 bullet points again. If you can know on the tip of your fingers, then the initial measurement becomes fairly easy. 4th is subsequent measurement, and There's two ways you could go with that. There's the cost model, which is used in 99% of situations, and then there's the revaluation model. Going into the CFE and for most situations in the workplace, the cost model, that's all you need to know. So to me, everything around outside the cost model is just noise. You don't want to focus on that, and instead what you want to know is the cost model. You want to be strong on that. So according to the cost model, PP&E assets are subsequently measured at cost less accumulated depreciation, less accumulated impairment loss. And when it comes to accumulated depreciation and depreciating an asset, there's really two methods you need to know. There's the straight line method, and then there's declining balance. So those are the two widely used methods, and they relate to the great majority of assets. The straight line method, it's depreciable amount, which is the cost minus the residual value divided by useful life of the asset. Declining balance, it's just you come up with a rate, and then you multiply that by the net book value of the asset. So those two methods, if you know how to apply them, then you know you're in great shape. And then lastly, there's derecognition. You derecognize a PP&E asset when it's being sold, when no future benefit is expected from the asset, or when it's being disposed of. It doesn't have to be sold. It can just be a disposition. And again, there's three steps. And if you know, once you recognize there's the disposal of an asset, there's a sale of an asset, then if you know the three steps there, then you know your journal entry and your tracking is going to be appropriate. So first step is you got to record a consideration received if there's any. So that's the cash usually. Then you got to eliminate the asset and the accumulated depreciation from your books. And lastly, if there's a difference, then it's recorded as a gain or a loss on disposal, and that would be an accounting gain or an accounting loss. So again, 5 points, know at the tip of your fingers, and if you do, then like I said, when it gets more complicated, a lot of the things will be just noise around the core issues for your problem.